With how important credit scores have become in just personal finance and day-to-day uses, it's important to know how to boost your credit score. In my last video, I explained how credit scores work with credit bureaus and things like that. This video is going to explain how to improve yours. My name is Jordan. I'm a licensed mortgage advisor. Let's get into it. Step one to improving your credit score, and I would say this is the most important part, is tracking and knowing your credit score. I talked about a few tools in the last video, but some of my favorites are myfico.com. There you can get a free FICO score. They also have a paid account where you can get all three of your FICO scores and your mortgage scores as well. So that's a great tool to track your credit score. Another one, legally you're entitled to one free annual credit report per year. You can do this through annualcreditreport.com. And this won't give you your credit score necessarily, but it'll give you a list of everything that's on your credit report. So things like your loans, any outstanding payments, those kind of things. The last one, if you have a credit card, so say you have a Chase card or a Discover card, in the app or online, you can check your FICO credit scorecard. When you do this, it doesn't affect your credit score at all, but it'll give you one of the FICO scores and it'll show different percentages of what's affecting your score and not. I'm going to go over the percentages now, but that's a great tool to see these, and that they're all free options. And so, like I said, most importantly, know your credit score, know what's on your credit report, and then we can attack these things from there. When we're looking at what affects your credit score, I want you to understand this. Everything that goes into your credit score is a measure of whether or not it's going to be risky to lend you money or give you new debt. So a lender, when I talk about these lenders, they can be mortgage lenders, credit card companies, personal loans, student loans, those kind of things. They have different percentages of what affects your credit score, and that's all based on whether or not they think that you're going to pay the money back on time and agree to the terms that you're supposed to. So the biggest one that affects this is, have you made your payments on time in the past? This affects 35% of your credit score. With this, it'll be reported if your payments are 30 days late, 60 days late, 90 days, or later. So when you're making a payment and say you missed it by a few days, you make your payment and you pay a late fee for that, that's not going to go onto your credit report until you're at least 30 days late on the payment. So I don't mean to say that you can just make your payments late whenever, because you'll have fees with the lender or the credit card company, and you don't want to keep showing that you're not making those payments on time. But it's not as big of a deal until you get to those 30 days. When you have a 30-day or later payment, it's important to know that it's going to drop your score right off the bat. About 6 months later, as long as you've continued to make on-time payments since then, your score will track back up. In about 2 years, it won't be affecting your score too much. And after 7 years, that's when the late payment completely falls off. The next biggest portion is your total debt amount owed. That makes up 30% of your credit score. And so I don't want to say a lot of debt or a little bit of debt, because that's different for certain people. But if you have a larger amount of debt than you've typically had in the past, then that can bring your score down. And when it drops your score down, once you show that you can handle that new amount of debt, your score will come back up. So with this, it's going to look across different loan amounts and those kind of things. But one of the most important parts here I want you to understand is revolving credit utilization rate with your credit cards. So when you have a credit card and across multiple credit cards, you'll have a total credit limit. So say you have 2 different credit cards, their credit limits are $5,000. With this, the total credit limit across your credit cards is going to be $10,000. You want to stay under a 30% utilization rate. So if you have a $10,000 credit limit, you want your balance at the end of the month to be less than $3,000. And this doesn't mean that you can only spend $3,000 in a month. You could spend up to that $10,000, and when you make your payment, you want to pay it down below at least that $3,000. It's even better if you can get it down to like 10% or lower than that. The lowest credit utilization shows that you've handled the credit cards well, and it's less risky to lend you more money. So with this, I want to say that the best thing that you can do if you're using credit cards is to pay them off in full each month. Not the minimum payment, but at least the balance. The balance from the end of last month is what you want to be paying off each month. That way you're not paying interest on the money that's rolling over each month, and it keeps your credit utilization low. While amount of debt and making payments on time make up the two biggest portions, the next one is the length of your credit history. This makes up 15% of your total credit score. So with this, like we've talked about earlier with risk, if you've showed that you've had debts in the past and you've been able to make the payments on time for a while, then that shows that it's less risky to lend you money than someone who just has brand new credit. So for example, here, if you've had credit cards for 10 years and you've made your payments, that looks a lot better to the lender than someone who just opened up a new credit card 6 months ago. And that's where kind of building credit happens, is by showing that you've been able to do this for a long time. That gets into adding on new credit. Adding new credit affects 10% of your FICO score. With this, and circling back to how it's risky, if you've showed that you just got a personal loan 2 weeks ago and you applied for another credit card last week and now you're applying for a new kind of debt, that looks more risky to the lender. That shows that this person may not have the money to pay back because they have these other debts going on, and they might be taking these debts out because they don't have the money currently to pay us back. And the last part, making up about 10% of your credit score, is your credit mix. And so this is seeing if you've been able to make payments in the past on different kinds of loans. So do you have credit cards and student loans and a mortgage? And if you've been able to make payments on all those, that shows that you're a trustworthy borrower of money. And this last one, I don't want to say that it's the most important for getting a perfect credit score. It's possible to just have credit cards, and if you've been making your payments on time and for a long time, you can get at least an 800 credit score from doing that. So don't think that you need to open up a new personal loan just to try and get the boost in credit score that way, because it's possible to just have a few accounts, and again, the other things add up to be 90% of your credit score. So just take care of the others, take on new debt as needed, and go from there. So now that we understand what goes into your credit score, what are some things that you can be doing to improve yours? First, I would say the biggest one is tackling your debt payments, trying to have lower debt amounts. Two techniques that people like to use for tackling debt are the snowball method and the avalanche method. These are explained pretty well by other people and pretty popular with, say, Dave Ramsey and Caleb Hammer and those kind of people. But just to give a quick overview, a snowball method is paying off the lowest monthly payment debt first and rolling in that payment to pay off the next lowest. The avalanche method is paying off the highest interest rate debt first and then rolling that payment into the next one and going down that way. I think they're both great techniques. The snowball method is pretty easy to understand and a great way to get started with it. The avalanche method, you do end up paying a little bit less debt over time by tackling the high interest rate debt first, but both great methods, and they're going to be really helpful for you if you're trying to lower your debt amount. The next piece of advice that I would give is to clean up your derogatories. If you have collections and charge-offs and things on your credit report, those do drop your credit score, and they do want to be taken care of. A collection account is still a debt against you, and by paying that off, it would help your credit score. There's a few methods around these that I won't get too deep into, but you can pay them off in full. It's possible to settle those debts, and it's even possible to do a pay for delete. So paying the full amount or settling for a certain amount, and the creditor might be willing to take it off your credit report. And while you're lowering your debt amount and taking care of those derogatories, then you also want to be working on building credit. Or say you don't have a credit score, this is how you're going to build credit the best. So first, I would start off with some sort of secured or starter credit card. A secured card works by paying essentially a down payment to the credit card, and that would be your credit limit. And you can borrow from that and pay it back. With this, you want to keep your payments low on it. Say get gas once a week or your groceries once a week and pay that off right away. That's going to show that you are borrowing money, paying it back on time. And again, it's just a time thing of how long you're able to show that you can do this. And one of the last pieces of advice, and this is one of my favorites, is being an authorized user on someone else's credit card. And I know it's not possibility for everyone. Not everyone has someone who would be willing to let you be an authorized user on their credit card. But if you do have someone like this, then what they do is they'll reach out to the credit card company. They'll say, I want to add this person as an authorized user. And if they have good credit and they've been making their payments on time, then that credit history will show up on your credit report. So say you have a spouse or a parent who's willing to do this for you. They can add you an authorized user. If they've been making payments on time for 10 years, your credit report would show making payments on time for 10 years. And that tackles some of the biggest portions of your credit score of length of credit and also making payments on time. So these are a few tips and tricks on how to improve your credit score. I know there's not a big, quick, easy fix for this. Building credit and fixing credit, it's a long game. But it's something that you can work on and it will slowly but surely improve. This can help you with getting better loan terms for a mortgage or credit cards or personal loans and those kind of things. So I hope this helped you understand your credit scores, how they work, how to improve them. I'll see you in the next video.